Okay, small cap of the week. I said high upside, so I'll try to fulfill that little tease here. The company
Gotcha.
is
I got some charts loaded up too, so I'll share them, whatever you need. What chart do you want first, Ryan, as you start describing this?
hmm, let's go revenue to start. Just
Yep.
annual revenue last whatever 10 years or so. So the company is FitLife Brands. Uh, this is another one that I found through it's actually, I think it's like a small cap hedge fund called Smoke Capital, but he does a lot of good kind of brief 4 or 5 paragraph write ups on companies as well throughout his letters. And he says, just the description of the company in one of his letters, he says, FitLife Brands is a nutritional supplements company that has made significant strides since near bankruptcy in 2017. FitLife's management team orchestrated an impressive turnaround through significant cost reductions, focus on core high margin products, and development of a high growth, high margin e-commerce channel. So it's been sort of this, I don't know if I'd call it necessarily a serial acquirer. It's got a number of different supplement brands in its portfolio. And then it also has, it acquires some throughout. So in 2023, they acquired, I think it's like Mimi's Rocks or something like that. I can't remember exactly what the name is. It was a bit bizarre. But Mimi's Rocks, Muscle Farm is maybe one people are a little more
Oh,
familiar with.
beautiful.
And they're able to buy these basically, it sounds like at 5 to 6 times EBIT most of the time. And what you get usually with a lot of these smaller brands is management teams that are running these brands pretty much for themselves. They want, they're compensating themselves really well. And so it actually kind of misleads the P&L. So you get, once you strip out that management compensation, and I think they bought Muscle Farm out of bankruptcy. So typically you've got legal fees associated with it as well. And you're able to put it into the FitLife portfolio. You get a pretty nice lift in profits. Not to mention the FitLife actual website and their direct consumer strategy seems to be going pretty well. So ads traffic there. They have good wholesale partnerships. The main one is probably GNC, since that tends to be kind of the predominant nutrition retail store base.
Do they work with a lot of those Instagram, TikTok, YouTube influencers? Because I feel like that would be a big market opportunity for them. Maybe that's a question you don't have for, or an answer you don't have for us yet.
Yeah, I'm not sure. They've got, it looks like 12 different brands in the portfolio at the moment, and I assume they would probably do fitness influencers since that seems to be the way that the industry has trended. And my guess here is that I don't know if there'll be influencer specific brands that are willing to sell, but I would guess that the industry has shifted that way a lot, where we talked about how influencers were launching their own tequila brands, influencers were launching their own fragrance brands, makeup brands, whatever it is. Fitness influencers launch supplement brands, tons of them, and they actually grow in popularity. They seem to be quite popular, at least among just like friends and people I've noticed that follow stuff like that. I wonder if those are acquisition targets for FitLife.
How's the balance sheet? Did you check that out? I guess we
I
should.
believe it was around $13 million in net debt.
Okay,
Not
so fine. And as what I thought was interesting is, again, so for anyone that gets watched the shared screen there, I can describe it quickly for the audio listeners. Stocks up 1,000% in the last 5 years, and all that happened. I mean, revenue grew a little bit, but all that happened. This is, I think, another example. We've looked at this plenty of times this year. Operating income went from basically zero to $10 million over a couple year period. That's all you need. You want to show that you can actually generate a profit, and that multiple expansion can be huge after that. Stocks up 1,000%. EV to EBITs, it was super low on a depressed valuation, or excuse me, on a depressed earnings multiple. Now it's up to about 15, according to our friends at FinChat. So another recipe, or another example of that recipe of accelerating revenue growth, low starting valuation, and basically going from close to break even or really depressed operating margins and expanding that through operating leverage over a couple year period.
Yeah, they recently uplisted to the Nasdaq, so
Oh,
a little
nice.
more liquidity there. They, I believe, I'm double checking right now on the ownership table. Own insiders apparently own 50% of the company, but I'm double checking right now. Which, by the way, FinChat recently uh, added full ownership tables as well. So yeah, 45% is owned by Sudbury Capital Management, which I assume is just associated with one of the executives, and then Robert Dayton uh, owns another 11%. So yeah, they own more than 50% insiders. Feels like one
Not
where the
bad.
incentives are aligned. They seem to have a genuine eye on the ball for what's most important. The market cap's 150 million, EV 160. You mentioned $10.5 million in operating income, so EV to operating income of around 16 times. I don't know. I think there's a lot of room for these little bolt-on acquisitions where it's just supplement companies ran for the executives. You can buy them, immediately strip out the executive comp, and a lot. Oftentimes, these are distressed companies
And
that are
they're
really
small
struggling.
businesses. They're not going to be that profitable, right? You're going to have that. I know this was the thesis for the Amazon roll ups, but that's probably didn't work. Hopefully, this would be a little bit different. But yeah, it makes sense. There's a lot of brands out there. I get that this industry can be tough. It's very trendy, but if you can get it right, CPG roll ups, some of the best performers of all time.
Yeah, it's. I don't want to say it is an Amazon rollup because unfortunately there is some Amazon, like I think that is probably a big sales channel for them, but there's other sales channels as well. And it's, if you're looking at it from a small business perspective, to really build a supplement brand just on your own, it's, you can generate 5-6 million dollars in revenue and still be struggling for profitability as a
Mm-hmm.
small business owner. So
You can take them out for $3-4 million, really cheap revenue multiple, and hopefully, yeah, roll that up. That makes a lot of sense to me. Here's my question for you, Ryan. We're investigating a lot of these that have gone up. What do you do as a screener, as a research item, as anything besides the Buffett A through Z method, which none of us, I think, are crazy enough to do? How do you find these before they go up 1,000%? I think that's the biggest question. For me, I think it's a screener on, we talked about the inflection from break even to $10 million in operating earnings. I think a gross profit screener makes sense to me.
yeah, I think a lot of it too is it's hard to screen for these things because most of the time the returns come from a turnaround. So the initial screening will be, it probably will exclude them, especially if you have any sort of like a profit criteria in there. I think a lot of the best small cap investors just build themselves a network of places and people that generate other good ideas. And